Hey, welcome to the podcast, weekend edition. It's November 16th, and we're going to go through a couple of things today, and obviously just touch on the overall market, and then get into some specific items and a question or two from viewers. So the stock market, you can see at new highs after kind of I guess a consolidation, you would call it, where we essentially went sideways for a few days. You can see we have now broken out and we're at new highs, and that's the case for the Dow Jones as well. Mentioned last podcast that there was some caution in the very short term because we were getting this just lethargic sideways movement, a little less participation in the market, and we started to see we did get one big down day that was followed up with a big up day, but since then we have broken out. Now at that time, we had talked about, being kind of tactical, not necessarily that this thing was going to end, because we think, even today, we think we're going to continue to make highs for a few reasons. Number one, there's simply the supply-demand figures that we kind of monitor, all the different indicators we monitor, suggest that this is not on the precipice of rolling over. This is simply a market that is getting stronger. And you would think, well, this has been going on for over 4 years now. How can that be? Surely it's got to come back down. Just remember, and I've said this before in previous podcasts, that when a typical bull market lasts about 3.5 years, and obviously we're way past that from the beginning of March of 2009. However, the recession that we had, the big drop we had in 2008, the financial crisis we had, took the stock market much deeper and further down than just a run-of-the-mill pullback. So given that, this thing could run on for a while longer. But again, instead of us just predicting that or trying to predict that, what we need to do is look at the evidence. And the evidence suggests, despite all of the headline risks sometimes, and despite debt talks and Federal Reserve talks and all of these things, which obviously matter, but instead of focusing on that, let's focus on what investors are doing. And right now, they're buying more and they're selling less. Now, again, as always, like with any of these, we can have a correction at any time for any reason, no matter what. And I talked about in the podcast about a week ago or so that we were hedging in our aggressive strategy, just our aggressive, because we have some very volatile stocks in there at times. We were hedging with a Russell 2000 short position. And so if we kind of zoom in, you'll see here, we put that position on somewhere in here, and the market did indeed fall. Now it's back up. So we're down a little bit on that position, but again, keep in mind that it's a small hedge against a lot of positions that are working. So net, we're still very long. So we're going to use that as a tight stop, probably somewhere about near this old high if it breaks through, and then we would exit that. So again, it's a nice insurance policy to have, and worked for a couple days, hasn't worked in the last couple days, but overall we've had some stocks that have been performing great, and the overall stock market just continues to move higher. And so again, you can still continue to do those things and say, well, if it rolls over, I want to be protected. How do I do that? Nibble at short positions, but don't be afraid to get stopped out and move on when the market moves against you, because at one time it is going to roll over and you'll be very profitable. So you can take a 1%, 2%, 3% loss on short positions. Just don't sit there and ride things down. So we know in the big picture this is getting stronger, not weaker. Now, a lot of you could say, well, it's probably just going up because Janet Yellen looks like she's going to be the next Fed president. She made some dovish comments this week, basically acknowledging she's going to continue the path that Bernanke has us on, which is more quantitative easing. And that could be true. I mean, a lot of this rally is because of that, right? But again, what are we trying to do here? We're trying to make money from it. And so what we're seeing is, regardless of the news coming out, we are seeing more strength in the underlying market. And again, if we go back to 2008, we go back to the year 2000, those big, because I don't think a lot of you are concerned about a 5 to even 10% correction. I think a lot of you are concerned about the market completely rolling over and completely falling apart. and turning into a severe bear market where we're down 30, 40%. And again, most of those, or I should say pretty much all of them, are usually preceded by a lot of warning signs. And we're not getting those right now. And then if you look at valuations on stocks, there are some ridiculous ones on the NASDAQ, but overall, this is not like year 2000. So there's still some good things going for the market as a whole. It is amazing that regardless of the news, whether it's good or bad, the stock market just continues to go up. And there was one other reason I was going to give you why I think we could continue to go up at least to the end of the year, is because when markets are this strong in the first 8, 9, 10 months of the year, they typically continue on through the end of the year. And so again, we've got that on our side as well if you're long stocks. So here we are in the S&P. You can see we kind of, it looked like we broke out a little bit, kind of came down to it, which is nice. That's what you want to see. And now we've broken up even higher. On the Dow Jones, we made some comments last time about that this was starting to make lower highs, and that was a concern. And since that time, it's broken out. And now, take these off, we kind of zoom out a little bit. Again, and we said don't get too specific with some of this, because for the most part, this market's been zigging and zagging and making higher highs and higher lows. And that's indeed what it's doing. But down here, we had gone to the 200-day moving average, which the other indices hadn't done that, bounced off it pretty sharply, and now we're at the top end. So, again, is this the time to be piling in? If you've got enough stocks, no. If you're making little adjustments, not a big deal. Or if you're getting very specific, if you're making specific trades in specific sectors, specific stocks, then you can feel free to do that. But it wouldn't surprise me, again, we're getting stretched here to see it start making our way back down. But again, until the pattern's broken, this seems to be the thing that it's doing, is it's zigging higher, back and forth and making new highs. Now let's look at interest rates for a minute, because interest rates are kind of interesting. They obviously were going up because of the taper trade, right? Everybody thought we were going to start tapering, and interest rates started to go up in May pretty sharply. Then we got to the point where the taper trade was off, and so interest rates came back down, found a nice little support here, which was this old level, and we started to break out again to the upside. And now that Janet Yellen has made these comments, now interest rates have started to go back down. But if I look at this picture, and this was a stock, not interest rates, it still looks like it may lean to the side of going higher, not lower. We put on a short position in our income strategy. I think it was right here, one of these 2 days. So basically what we were looking at is this breakout that looked like it was appearing. And sure enough, we had that big jobs report, and so interest rates really skyrocketed that day. Our short position went up 4.5% in one day on that. And since then, it's kind of meandered sideways. And you would think with the talk of Janet Yellen that this thing would be coming way down, and it hasn't. So it still looks like, from a perspective of just looking at it as a chart, that we came up, we kind of rested, and now we're breaking out, and we're doing this pattern. So let's see. Again, you would think with, you got conflicting data sometimes. We have the Fed's going to continue to keep interest rates suppressed, and the data has been mixed at best. However, interest rates probably will grind higher. Will they spike up? No, they took an initial jump back from May to September, and it was a big move, right, from 1.6% to almost 3%. Now they're at 2.7%. So we could see them grinding higher to where almost a short position in rates may be a core piece of what you do to hedge out some other things you want to do for income. So that's kind of the update on rates. Now, when we switch over to the VIX, the volatility index, you can see, again, as the market's been zigging and zagging, so has the volatility index, but we're breaking down now. We're going down to lows we haven't seen since August, and so people are getting very complacent. And immediately when I hear the word that investors are getting complacent, your antennas go up and go, uh-oh, I should probably be selling because Karl says people are getting complacent. Well, complacent is actually okay if you're in a bull market. Just like fear, which you always hear, buy the fear, sell the greed, buy the fear. You don't want to buy fear in a bear market. because the people that are fearful are the correct ones. They are justified to be feared because it's a bear market. Right now, the people that are long stocks, benefiting from it going up, are complacent. They are correct to be complacent, and maybe that's the wrong word. Maybe you should never be complacent in this thing we do called investing. But for the most part, let's just say they're confident. They don't have a lot of fear, and that is the right thing to do. So every time it comes down to these levels doesn't mean you should necessarily sell the market. In a bull market, what you want to do is buy the fear. That's how you make money in a bull market, is buy the fear. In a bear market, you want to sell the confidence. But we're not in a bear market. We're in a bull market. So you got to concentrate on this up here. Down here doesn't really help you much. So make sure you're using these fear indicators correctly right now. Just to touch on oil very quickly, I think oil could find a spot, find a home. Let's call it around, close to where it is right now. Maybe let's even call it $91, $92, somewhere in there. And again, just looking back at the chart from last, I guess this is middle of 2012, and just connecting the dots here. We're at a spot, this yellow box is where we probably should bounce. I could see it bouncing up to around $100 or so. If it's going to continue lower, that would be the spot. Maybe it would start to roll back over, or we just continue higher. But I think we're getting to a spot right now where if you're a short oil, perhaps you should reconsider that short. Okay, I want to talk a minute about some of these high-flying stocks. I got a question from a listener, viewer, basically said, I've been in and out of a few tech and medical stocks over the years. In the past, when I had a doctor's appointment, I'd ask my doctor about a drug and kind of why he liked it, why he didn't, why she liked it, why she didn't. And he says, just like Twitter and Google and Apple and Facebook, I've seen these tech companies come out, but I never get in on the ground floor. What can an individual investor do to participate in these IPOs? What's the best investment vehicle to do this? And, basically my answer to him would be that it's very hard to get in on an IPO, especially nowadays. And the big institutions are the ones that typically get the allocation. So remember how this works. Company says we want to go public. They sell their shares to the public, but there's a company that helps them do that. They get a lot of the allocation to distribute to their clients. So, for example, Twitter went public $26, but by the time it actually hits the exchanges, it opens at $45. So it's kind of like in retail. You're paying retail for a lot of these IPOs where you want to be getting in on wholesale, and it's very difficult to do that. But there's another technique, and if you look at something like Facebook, and I've noticed this pattern for a while now, Facebook comes out and goes public at $49, and then it immediately drops down to becomes a teenager. It's at $18, $17, $16 right in here. You get a second chance on a lot of these. So, you don't want to be buying right here necessarily unless you can average into it or you feel very strongly about it. If you got some reason, fine. But for the most part, if you're wanting to get a better deal, a lot of these find their place later on cheaper and you get a second chance, right? And we can even go back to a non-publicly traded company like Netflix. Netflix, this goes back to 07, 08 time frame. And again, the public goes way down, finds it's kind of where it's supposed to trade for years and years, going sideways, right? Then it has this huge run. So you had a chance back here, but even if you just heard the Netflix story in the 2010-11 time frame, you said, man, I missed it. Oh, well. You got a second chance down here. And now look, it's going up and doing another run. So the point is that a lot of these companies, Groupons, the Yahoos, Facebooks, Twitters, all those companies, right after the IPO, tend to settle in. Rarely do they go public and just take off, and it's because they're overhyped, they're overpriced. Twitter is not a bad example if you take a look at it. And what we'll do is we'll switch to the a 15-minute picture. So here's Twitter, goes public. Now remember, $26 was the IPO price. It's not on this picture. You notice 26 anywhere over here? No, it's because 26 is way down below, and those were people who got in on the actual IPO. So it goes public at 49 bucks, $45, runs up to 50, then it heads straight down, breaks 40. At this level, it finds some support, and now you see it starting to kind of trade in the 43 to 44 range. So it's settling in there. But what if this overvalued company, which it is overvalued, but it's a brand, it's a company that probably most mutual fund companies will own. What if it falls down into the 20s? Well, now you are getting it back at the IPO price. So I'm not saying you'll ever have a chance to do that, but don't feel bad that you miss out on IPOs sometimes. Okay, but for how do most people get in on IPOs? It's difficult, and again, a lot of these. There's another way to do it too, which is to invest in the private company. There's some exchanges that you can invest in private companies. If you're accredited and so forth, you can sometimes do that. So you get in on the ground floor basically. But for the average investor, very difficult to get in IPOs, and you're better off watching something when it comes public, let it settle in first, and then go in that second phase to buy those. Okay, I'm going to give you an example of a company or a chart that is difficult to navigate. Okay, this is a company we own in our aggressive strategy called HomeAway Inc. And I'm not showing you this to make you run out and buy it. I'd actually prefer you not do that. But we've seen a lot of pictures like this. So we own this company HomeAway. Now we've owned it for a few months, and it was kind of in this box. And it's a very fast-growing internet-based company. They basically do, when you want to go, they own VRBO. So if you ever use vacation rental by owner, basically people pay a fee to list their properties on there, their beach house, whatever, and then you go and you can rent the house from them directly with the owner. HomeAway gets a fee for doing that. And they've got a couple different models. They're expanding internationally. It's an Austin-based company, but very fast-growing, very high multiples, etc. So we own this thing. It's in this sideways channel, and it's zigging and zagging, and at one point we're down about 10% on it, but we really like the story here. But now they come out with earnings the other day, and the stock gaps up quite a bit. So remember, this was a stock that was around 27 bucks just in early October. It's now at $38. So it's going vertical. What do you do here? And you've got a couple of options. Number one, if you've got a large position in it, you can afford to sell a third or a half of your position. So that way, if it continues up, you still have a reasonable amount. However, if it pulls back, you've locked your price in. So you've got options there. But what if you don't have enough to do that? You only have your one chance to buy it or sell it because of transaction charges or whatever the case. Well, now you have to obviously look at the fundamental story. But in addition to that, let's look back. So now we turn it into a weekly picture, okay? And we go back, and this thing came public in 11. Again, it goes back to the same story I was talking about, right? Comes public way up here, and then ends up getting cut in half, and spends a lot of time down in this lower, we'll call it 18 to 27 time frame or dollar amount. Then it goes up to a new level. Now people are giving a little more of a premium. 27 to 35 is the new levels. Now it looks like it's going up to another level. So here's the old high. So logically, you could say, hey, this thing looks like it's going to head up here, and now it's going to start. Let's call it a new box or a new oval. I can't find my box, so let's call it a new oval. But you've got these different stair-step ladders where it goes here, goes up to another level, trades there for a while. Remember, we're looking at weekly, so this can take a year. So now that it goes up here and it trades this way until earnings, all the different metrics we look at, we want those things to catch up to it, right? So that's kind of a longer-term play if you're really wanting to invest in the company. But if you're looking at it from a trading perspective, which we were as kind of a hybrid, we like the fundamental story, but we also were looking at it as trading. We're up, quite a bit now. I don't know where we bought this. I don't have it in front of me, but basically, obviously we have a really nice gain in this thing. Anybody that bought it, going all the way back, basically since the IPO days, has a nice gain in it. So a lot of people there that want to take profits on it at some point, including us. But look what's going on here. Volume is increasing, so it's important to watch volume because we want to see confirmation. This shows that, and by the way, this company had a large short interest, So that means a lot of people are betting against it. Now what do they have to do when they come out with good earnings? Cover their shorts, more buyers. So you're seeing volume increasing. You could be seeing some institutions get in here. This is only a $3 billion company. It's not real big. But what we are doing is basically setting a stop. We're essentially saying, hey, we're going to set some price level where we want to put a stop. That way, if it comes up and then it comes back down, we can have a floor in there and we lock in our gains. Now, you do run the risk of it opening here one day. You just wake up in the morning and it opens at $35. I don't think it's going to do that, but you also don't want to cut it off too quickly. There's an old adage on Wall Street that says, don't trim the flowers to water the weeds. What that means is don't sell your winners and then take that money and go buy losers. So, for example, if you're somebody that owns Cisco Systems, right? Cisco had a very bad week, and the stock is going way down here. You don't sell away necessarily to buy Cisco. I'm not saying it doesn't always work, but stocks that are weak tend to stay weak, and especially in this market, stocks that are strong tend to stay strong. So, but this thing, you can see it's going outside its Bollinger Band. So you've got some conflicting things. There's no reference point here. Where is it going to stop? It's very extended, but it's got higher volume. So what we're going to do is basically put a stop on it. It could become a big enough position to sell half of it, and we've done that with some other positions before. But this is an example of a stock that's going vertical. And here's the thing. A couple people asked me, clients that own it, when it did this, when it had this gap up, why don't we sell it? Why don't we sell it? We made a little bit of money. Why don't we just go ahead and take our profits? And what we had noticed in this environment is that the market had a lot of these stocks that do this, they gap up, they rest for a couple days, and then they go off to a new level. And if you take a look at Facebook, which we just looked at, same thing. Look what happened. And it's very tempting to take profits when it gaps up like this, but look what happened. It gapped up and continued higher. How about Netflix, which we talked about earlier as well? Remember back here, some of their key metrics had changed. Gapped up, and that would have been time we said, no way can this thing keep going up. I was saying it's going to pause and go down for a while, but all it did was move sideways, and now it's gone up even higher. So again, if a stock pops, there's a reason why it went up. It's because if it gaps up like this, their earnings justified a higher valuation, higher price now. But that's not to say you should get greedy. I mean, I looking at this chart, I'm not anticipating this thing to go like this. It would be nice if it did that, but I don't think it's going to do that. What's more logical, especially with this pattern here, and let me kind of zoom out and scoot this back a little bit. What's more logical is we were in a sideways pattern. We've now broken out. It would not surprise me to see it come down somewhere near $35 over the not necessarily near term, but at some point, and then maybe it takes off again. And at that point, that's when it's an easier buy if you're looking to get into a stock. So again, this isn't a suggestion to buy the stock. This isn't a suggestion to sell the stock if you own it. This is pointing out a chart pattern that's going parabolic, and it's going straight up. But I've seen parabolic moves in this market, 2013, that don't just come straight back down. They will zigzag and stay up at this lofty level and pause and then go up even higher. So, that's why you need to set your stop if you're doing that somewhere that gives some room to breathe. Okay? And again, this is something we own in our aggressive strategy. So that means some of the people I advise own it, and a lot of people don't, because this stock again was down 10% at one point when we owned it. Some people wouldn't want that, right? They don't want that type of volatility. Others do, and so it's a big risk, big reward. But it's just to point out the type of action that you can see in this market, and a lot of stocks are acting that way, by the way. All right. Okay, that's a wrap up. Keep in mind that, again, stretched in the short term, we are still seeing great positives as far as, again, equity flows. Not necessarily, we're not arguing about fundamentals. We're saying equity flows. We think rates could continue to trickle higher. But overall, stay in the sectors that seem to be working. Maybe exit the ones that aren't. Keep stops on things that basically, like we talked about, go parabolic. And look for things that are working, because there are plenty of things that are working right now. Don't forget, email me. I answered a question today. Email me if you want, Karl at eggerscapital.com. We'll answer your email. And also, we're on Twitter, twitter.com/Karl Eggers, eggerscapital.com. We're on Google+. We're on Facebook. We are on iTunes. We are on StockTwits, if you're into that. Where else are we on? We're on pretty much everything out there. So make sure you check it out and have a wonderful weekend.